Hello, good afternoon, everyone. Thanks again for being with us. We have the honor to have Jay Pelosky here for one more great discussion on investments. And without further ado, I think I'd like to turn to Jay. But before I do, some of you or most of you may have seen the Musings that Jay publishes every Friday. We publish that on Own Research, and the last one had quite a cool title, which is G, for governance, growth, and goodbye, Gamestop. So I'd like to turn back to Jay, and so he can talk about more what that title means, and then we'll move on. And I have a series of questions, and some of the important things that are moving markets this week.
Great. Well, thanks, Roberto, and hello, everyone, and great to be with Own Research again. And on those musings, Roberto, the whole point of them is to try and distill down all the things I've been thinking about during that week and present them to clients and interested parties in a very kind of concise fashion. So last week's, for example, was 1,000 words roughly, which should take about 4 minutes. And I typically try to keep it to like 500 to 600 words, but there was just so much going on last week in terms of the G is for growth, G is for governance, and G is for goodbye, Gamestop, that it took 1,000 or so words. But I just want to encourage the folks to take a look at it. I think you'll find it covers a lot of ground and gives you some things to think about over the weekend. And then together with Roberto, now we're doing this bi-weekly video live session where we can flesh it out and folks can ask questions, etc. So for me, I'd like to make maybe the first major point I think I'd like to make is that the environment we're going into in terms of global growth, what I call the global economic boom, is unique in terms of virtually anyone investing in the current day. And what do I mean by that? Because that's a big statement. What I mean is that the global growth for 2021 and 2022 is likely to be the best 2-year growth period since the early 1970s. And so that means that, again, 50 years ago, and some of us may have been around, I was around, but I was just a kid, nobody investing has experience in that kind of growth environment on a global basis. And then the second follow-on point is that we are entering into a bear market in US Treasuries, which has not been seen since the early 1980s. Interest rates peaked in the United States in 1980-81 and have been on a pretty consistent downtrend over that last 40-year period. So fixed income investors going into the next couple of years have never really been in the environment that we're going into. So I think this means for investors, we have to try and ensure that we have a process, that we have a discipline, that we have a framework to kind of guide us through this unprecedented time. And for us, and for me at TPW, it's really our tripolar world framework, which looks at regional deepening and regional integration in each of the 3 main regions of Asia, Europe, and the Americas. Underneath that is our global risk nexus, which allows us to look at health, economics, politics, policy, and markets in each region and globally. And those are the things that guide us in terms of how we think about the environment. And to me, it suggests that we're going into a less generous beta market and a greater need to identify alpha generating opportunities. And how do I think about this is I look at the 60-40 returns, right? A straight traditional 60% S&P, 40% bonds over the last decade from 2010 to 2020. That simple allocation returned 10% per annum. If you look at smart people like GMO, KKR, AQR, others who forecast those type of returns going forward, the next 5, 7, 10 year 60-40 returns are in the 1 to 2% per annum range. And so this suggests to me that we need to be, as investors, we need to be better if we want to be successful. If we want to have anywhere near the returns of the last decade, it's going to require a lot more work. And this has implications for all investors, whether individual, retail, do-it-yourself, family office, hedge fund, IRAs here in the U.S., pensions, endowments. It's, I think, a very, very big issue. And for me, the answer is in thematic investing. And so thematic has been around for the last couple of years. Last year was a kind of a breakout year with the folks at ARK and elsewhere. But to me, the thematic investor or thematic investment opportunity is where folks are going to be able to add alpha, and where the ETF instrument is a perfect vehicle. So I spend a big chunk of my time the last couple of months and on an ongoing basis trying to identify those thematics where I believe we can add alpha. And I note in my musings that I just updated our model portfolio. As you know, we do model portfolio delivery at TPW Advisory. And at the moment, the thematic kind of slice of that model is over 20%. And I think that gives you a pretty good illustration. So it's no longer simply stocks versus bonds versus commodities versus alternatives. It's no longer US versus Europe versus Asia versus Brazil versus Turkey. It's all of that, plus how much exposure do I have to clean energy? What's my exposure to electric vehicles? How much do I have exposure to innovation? What's my exposure to infrastructure, to fintech? And this is the way I think investors, and certainly global macro people like me, are going to be able to make a difference and add value to people's portfolios. So the first thing that I spent some time on in the musings was on this idea of a unique environment, never really seen before in terms of folks investing today, the implications of that on beta and alpha, the need for a framework, and where I at least see the opportunity to add alpha, which is in those thematic buckets, as I mentioned.
No, this is great, there's a question I had to the end, but given what you just said, I mean, I think it's interesting to bring it on now. You're talking about growth and in this environment, the best environment since 1971, 72. Looking at 2021, 22 with respect to growth. It seems that people are panicking about inflation, and despite the Fed rubbing in front of them, every day or every other day you have someone from the Fed saying that, okay, you're going to have some nasty inflation prints in the next 2 to 3 months, but don't panic, we're not going to raise interest rates. So I mean, why are people so nervous? And with respect to growth, I mean, highlighting two of your great calls. I mean, you mentioned XLE, on the musings on Friday, and it's up nicely today, which is more than just saying generically that the reopening trade is back, but also you have this very out of consensus call on the US 10-year. And I got 10 people to questions from 10 people over the last few days. I mean, is the US 10-year above, not even 2%, but above current levels? Does that derail the bull market? And over to you. I mean, I think there's a lot to be covered in these two questions.
Yeah, no, that definitely big topics, big questions, and good important questions. Let me kind of go at it in a somewhat logical, but maybe a little bit long fashion. And I'll start with the idea of governance, because we touched on G is for governance, G is for growth. And I put them in that order for a reason, right? And in the United States, the reason is that what is going to generate this kind of way above consensus growth or above the norm growth. And I'll give you an illustration of the relationship between governance and growth. Morgan Stanley, my old firm, just raised its 2021 US GDP forecast to 7.6%. 7.6%. I mean, those are Brazilian style, back in the old day style growth numbers. Those are not US developed $20 trillion economy growth numbers. Now, why did they do that? They did that because a couple of days ago, Vice President Harris went to the Senate and broke a 50-50 tie and allowed the rescue plan, the $1.9 trillion rescue plan, to go through the reconciliation process, as opposed to having it stymied or sharply reduced by the Republican Party. And that ability to meld monetary policy, which is already full bore, with fiscal policy is how you get that kind of a pickup in growth. And I think, again, it cannot be understated or overstated in my view. You should shout this from the rooftops. I believe that the US is ending a 40-year period where the effort was to shrink and reduce government. Right from Ronald Reagan's The 9 Most Terrifying Words in the English Language. I am from the government and I'm here to help. And the Trump administration is the logical culmination of that mentality. And the Trump agenda was the complete deconstruction of the administrative state. And that has left us with a very poor COVID response, among other woes. And so I believe we are at a pivot point, and I feel so strongly about this, Roberto, that I even attached a link to a New York Times piece that made the case for the first post-Reagan presidency. And this is what I mean. The Reagan ethos of shrinking government has been the predominant focus of the US political system for 40 years. And I'll illustrate that by saying that of the last 40 years, there have only been 4 where Democrats control both houses of Congress. Only 4 out of 40. So now the pivot point from the kind of deconstruction of the state from the Trump administration to a new Biden administration, which is filled with people who are A, believers in government, and B, experienced in government. And so they have almost all, particularly in the economic space, are almost all veterans of the Obama administration. And they understand that going too small, going too late is a problem, and left us with the political fallout that we've had to endure in the United States in the last couple of years, and most recently in the attack on the Capitol building. So there is a tremendous need, right? Whether it's COVID, jobs, the economy, climate, inequality, tremendous political needs, and tremendous opportunity, because money is as cheap as it's been in modern, and certainly in the last 50 or 60 years, 70 years since, in real terms, since World War II and just after. Money's never been cheaper in the United States. So huge needs, cheap money, control by the Democrats, makes political and economic sense to go big, and they are going big, and to make the case, which they have done. The rescue plan is polling at over 2/3 public support, and the opportunity is to demonstrate that government is good. Government can help you in this time of pandemic and woe, and unemployment, and shuttered businesses, and therefore politically strengthen the Democratic Party for 2022 and 2024. So theoretically, one could think about 8 years of Democratic control and an environment that would look very, very different than the last several years. And so this, whether you agree or not, and people obviously are free to disagree, it's not a consensus point. Again, one of the benefits of working with me and TPW is it's an independent point of view. It's an original point of view. It's a point of view that will hopefully make you think and differentiate your investment performance. But the asset allocation implications, Roberto, are huge because when you think about this growth profile, when you think about this activist government, then you need to think about a for sure bear market in U.S. Treasuries, right? So it reinforces the bear market, a likely secular weakening of the U.S. dollar because you're going to run significant deficits. And I think the potential for a continued reflation, rotation, non-U.S. leadership, the continuation of what I've called the golden age for asset allocation. Because if you have these things play out, then you will have cyclical and value outperformance. You will have underperformance by the big tech stocks. Remember what I've been saying for months and months and months. Rising rates plus a vaccine equals kryptonite for technology, for big cap tech. And I think we're seeing it play out. You had fantastic results from the big tech companies. Didn't really do a whole lot. Yeah. And so the opportunity set is in the innovation and disruption of tech, the young tech, the new tech. And this helps one explain, and I'm going to get to the treasuries, but just want to make the point that in my view, what we're seeing in the IPO market, what we're seeing in SPACs are not signs of a bubble. They are signs of the financial capital market system working to provide investors like us more opportunities in these new disruptive and climate related spaces so that the system, as opposed to being a bubble, which is such an easy default. I mean, people just, oh, it's a bubble. And therefore they don't have to think, they don't have to act, they don't have to change their portfolio. It's a bubble. But it's not a bubble. It's capital markets taking our money and helping us allocate to different new emerging segments of technology. So when you think about the innovation curve, you're actually, as a public market investor, getting closer to the early adoptive stages of the technology cycle, which is where you want to be. And I'll leave you with one data point, and then we can turn to the treasuries. When the term tech unicorn was coined, less than a decade ago, believe it or not, seems like it's been around forever, right? But a decade ago, there were 47 billion valuation private tech companies. Today, globally, over 500. So there is going to be a consistent number of IPOs coming, whether it's via the traditional route or the SPAC route, huge volume coming through. The venture capital space is up dramatically year over year. So there's the whole idea of COVID speed, capital, financial, and intellectual focused on a single issue, got us a vaccine in a tenth of the time, now pivoting to climate, to fintech, to cyber. And this is, again, where the alpha generating potential, I believe, for the next several years is really going to manifest itself. Let me stop and see if that generates any questions, and then we can quickly turn to the treasury market.
You know, I have a quick follow-up question, and it's just curiosity. What were these 4 years out of the 40 that you mentioned? You know, which administration was that?
You're not supposed to ask those kind of questions. There 2 years in the Obama administration, and then I think there were 2 years in the Clinton administration. To be honest, I don't have the exact years off the top of my head, but I know it's 4 out of the last 40 for sure.
And I agree with you that you know this is the case, but it doesn't seem that people understand the implications of that, in terms of what that's going to do. And you mentioned a very good point about the U.S. dropping out of the competitiveness index, and and then referring back to the last to our last call, 2 weeks ago, when you said that not now I forgot the name of the person, but the senior officer in the administration said, investing in equity is good for business, and it's good for the economy. So
Susan
I,
Rice.
I don't think and people still have that mentality, which is okay. Gridlock is good because well, for fiscal, they're fiscal hawks or whatever. But this time, there's so much that needs to be done that maybe they should think differently.
Yeah, I think that's exactly right. And the key difference is that gridlock is fine in a unipolar moment when the U.S. is the hegemonon and nobody else can compete. And today, again, the value of the tripolar world framework, if you think like that, you know immediately that we are no longer in a U.S.'s hegemon environment. We're in an environment where Asia is competing and China is leading that competition, and Europe is competing and focused very intently on its own integration after dealing with Brexit and some of the fallout of President Trump. So the gridlock and the point I referenced in the innovation is exactly right. I noted in my musings on Friday that the World Innovation Rankings just came out. In less than a decade ago, the US was number 1. And today, in less than a decade, we're number 11. And if you accept the idea that innovation is going to drive performance and going to drive growth, then you don't want to be 11th. And you can't afford gridlock. I firmly believe, as an American, that if we were to have another 4 years of gridlock, we would wake up in 2025, 2028, and the U.S. would not only no longer be the hegemonon, it would not even be a leading player because things are moving so fast. Again, we're in COVID speed. And I'm sure you feel it. I feel it. It's very visible in the markets to me. And so but at the same time, it makes sense that this is not immediately seen or accepted or recognized. This pivot of 40 years, this implication of a 50-year unique growth period in front of us. These are big things, and there's so much stuff that's right in front of our face that it's hard to pull back and see the big outlines, which again, I think my framework, the tripolar world and my risk nexus, something I've been using both of these for well over 5 or 6 years. The tripolar world is more than 10 years old as a thesis of mine, that I have a pretty good sense of the big picture. And that's why I said it can't be overstated. I don't think you can overstate how important it is if the U.S. does in fact transition or make a pivot point from government is bad to government is good. And we have all the needs, we have cheap money, so politically and economically, it makes sense to go big. And the good news is that this is true not only in the US, Roberto, but it's also true in China, where China is very focused on its dual circulation strategy to drive its own domestic consumption. So when you think about the global economy, the US potentially growing at 7% per annum, China growing, I've seen estimates of 9% GDP growth in China this year, focused on domestic consumption in the working class, US focused on the working class. I think you have to kind of rejigger your mental map of how things can play out. And of course, this will have implications for government bond yields. And so in China, you have the 10-year yields over 3%. Pretty good shape, offering positive real yield. In the US, we have a 1% or 1.2% 10-year. And as I think I mentioned in our last conversation, that was the consensus number that stuck out to me the most in reading the 2021 outlooks from the various banks and prognosticators. Everybody had the same 10-year at 1.2, 1.3. I'm in print from December saying that I expect it to be between 1.75 and 2%. And it's a pretty simple reason why, because you're going to have that kind of growth. You're going to have a tremendous supply, and you're going to have an opportunity to where folks can be looking at other areas for investing as opposed to safety, which we've had for the last 12 plus months, focused on buying treasuries because that's a safe asset and I know I'm not going to lose a lot of money. But if the treasury goes from 1% to 2%, you're going to lose money in your U.S. treasury market. So we are in the model very underweight sovereign, very underweight U.S. treasuries, very underweight European sovereigns, because this is also true, albeit to maybe a lesser extent, in Europe. And I just make a note that the bonds, the 10-year bond is at its lowest level in 6 months or more, at roughly minus 40, 42 basis points. So there's I think, and you mentioned Italy, there's a very good chance that you see that 10-year bond moving towards zero, and potentially fairly quickly, because I do think that the Gamestop episode was one of the last best opportunities to position for the reopening that I expect to see in the US and in Europe in terms of economic and financial market performance over the next 3 to 6 months.
No, that's great. I have a couple of follow-up points on this. So I mean, on the treasury, it's clear that we're going to have that kind of growth, and there's not the safety anymore. And the Fed, has been, rubbing in our faces. So I guess that's clear. So, but you mentioned World War II and the best growth in 70 years. Something that I've heard before, and I'd like to know if you agree, is that people should not worry too much about the debt levels, because the environment that we're going to see in the next few years is similar to what we saw after the war, where major economies, or the U.S. in particular, emerged with very high debt levels, and there was some substantial financial repression in those decades. So and still, I mean, of course, it's a different story. But when you talk to Europeans, and they talk about it's they call the 30 glorious, either in Italy or in France, the 50s, 60s, and 70s, as but there are other things in play as well. So to what extent do you think that could be similar, and we'll have high growth with some financial repression, will play very well into your scenario of the perfect scenario for asset allocation?
Yeah, and I think that's right, for commodities, for cyclicals, for value, all the things, by the way, which haven't performed for years and years and are coming out of bear markets. I mean, you have one segment, I think I wrote with maybe a question mark, because I'm not sure I have 100% conviction, but is the top in terms of the tech weight in the S&P. I mean, remember financials just before the great financial crisis were some huge number of the S&P, and then it just kept going south. Look at energy. We touched on XLE, which we hopefully can talk about more in a minute. But, energy is now 2% of the S&P. It used to be 10, 12% or more. So technology at whatever, 27, 28, depending on what you want to throw in there, 35%. I've seen estimates as high as 40%. But I think we're probably much closer to the peak than we are to anything else in terms of tech weighting in the United States. And so, yeah, these are tremendous moves, and they are, suggestive not of tactical, but of strategic asset allocation moves, multi-year secular moves, which typically tends to happen when the U.S. gives up leadership to the non-U.S. equity markets, or vice versa. It's not a 2-month or 3-quarter move. It's a 3 to 5 year type move. And I think that's where we're at the very beginning of that. Similarly, growth to value. It's never been so distorted. Think about commodities at 10-year bear market. So to me, we're going to have a couple of quite high inflation prints in the United States. because of the negative numbers from last spring. But that's transitory. I think the Fed will look through that. They're trying to tell us they're going to look through it. We talked about it last time, inflation, asymmetric inflation targeting, AIT. The ECB has the same. So they want to see inflation run high, a little bit of the financial repression you mentioned for sure. And that has implications for, all the 60-40, the risk parity, the balanced portfolios. If you total up all the money in those strategies, it is a humongous amount of money, and it's going to have to be on the move in the next year or two. So I think that's why these move, and that will provide the money to give the other things we've touched on, the second and third legs to go higher. So you're going to have headline inflation in the U.S. of 3%, maybe 4% in the next couple of months. Those headline numbers. The Treasury market's probably not going to react particularly well to that. The U.S. technology sector will not act well, given cash flow valuation work that's done by every brokerage firm on the street. And that's what tech is telling us now. It's no surprise that tech is stagnating, even with fantastic results. And by the way, the results are not going to be as good in the year ahead because the work from home was a pull forward to an extent, and therefore is not replicable. And so you have, again, reinforcing of the cyclical value allocation. Financials should do very well. Energy should do very well. Materials should do very well. Small caps should do very well. Europe, Japan, cyclical markets outside of the U.S. should do very well. And you want to think hard about your fixed income exposure. Like one of the things I'm thinking about, just to put it out there, is something like an AMLP, okay, the pipeline opportunity in the United States. It has a 9% yield. Does it make sense to sell my whatever I have in long duration assets and move them into something like a MLP structure, which would benefit from the appreciation in the oil patch and the desire for yield, as opposed to EMB, for example, emerging market dollar debt, which now yields about 5%, but has the similar duration exposure to the Treasury market. So there are those where do you seek yield? And that's why, again, I referenced XLE. XLE has a 5% dividend yield. And you just had the biggest single component, ExxonMobil, last week tell you that dividend is safe. You also have OPEC maintaining its supply constraints, and you have President Biden reinforcing the lack of drilling on federal lands. So would I rather have a 5% yield in an asset that's been in a bear market, or would I rather, as an illustration, the triple C's in the United States, the most risky part of high yield, yields 6% on average right now. So, I mean, it just shows you how distorted things are, but where the opportunities are. 6% for a basket of triple C paper versus 5% for the biggest oil majors in the world. To me, that's a pretty easy call. And as I, again, have said since the late fall, you can make money in both old energy and in new energy. XLE is old energy, the clean energy, ICLN, QCLN, the electric vehicle plays, etc. Those are clean energy, new energy, and you're able to make money in both of them. So to me, the environment is such that you're going to see much higher Treasury yields. The Fed is not going to do much of anything. It's transitory. Don't think that we're going into a high inflationary environment, because you still have the demography and the technology and the other factors that are going to kind of repress inflation as they have for decades. That's not going away. Those are huge factors. But you will have supply, the shortages. You are going to have supply-demand imbalances, like in the semiconductor space, right? I mean, there is this choppiness that I believe if you think and expect it, you can play offense with it in a portfolio sense, as opposed to playing defense. And that's kind of what I'm trying to do.
No, it's great. And so yeah, I guess we can close off, the topic of of the U.S. Treasury. I mean, I think we're going to have the growth, and and the Fed, is going to allow inflation to run hot a bit, and it's the issue of financial repression, which is something that we need. And the Fed has been telling us that. I would like to ask a question because it involves also the COVID speed that you mentioned. That put together with the energy space. So you have you talk about new energy, old energy. First question is, okay, is there a scope for new energy to be included in the when you look at the weightings of the energy sector in the S&P? But the COVID speed question is, in my opinion, people are still very skeptical about the change. In the speed of change with respect to climate change and the policy towards climate change and what the U.S. is going to do. And let me know if you agree. But to me, the reason why people are still cynical and they don't understand what the government is going to do is that maybe finally technology has taken over. So this is the first generation which has seen the impacts of climate change. And the last one that can do anything about it. So for the past 40 years, everybody, people that listen to science, they know that everything that they have been saying is right. But now people are seeing the effects, and then you have also the question of the millennials. And just as a comment, I don't know if you have seen, there was this city, I forgot the name, but it's the coldest city in Finland. And they have presented their candidacy for the 2032 Summer Olympics as kind of a protest. So, of course, it's a bit of a joke, but
right.
You have like Elon Musk giving $100 prizes for carbon capture, and people talking about geoengineering. So I don't think people appreciate how fast things are going to move. Because they're sensible people now, and the U.S. was missing in the equation that really see this as what it is, which is a real challenge. I mean, it's an existential challenge for mankind.
I agree certainly with those last comments, and agree again with the idea that people are appreciating the speed of change, and that's why I try to tie it to the COVID speed, to the speed of science in creating a vaccine in 1/10 of the time it has taken historically. That is a fact, and as I say in the musings, we're learning creatures as humans, and we have seen the model, right? That is the model. That's the model of unlimited financial capital plus global intellectual capital focused on a single issue. And you have a vaccine in 1/10 of the time. And not just one, but 4, and they all work really, really well. And that's why, I'm confident that we are very close to consistent success against COVID. And therefore, the things like the Gamestop foolishness in the last week or two is a great buying opportunity to position for the reopening trade. And I tried to make that case, directly. I was on a Bloomberg and had the chance to speak directly to it like 2 Thursdays ago, and said it was a sideshow. And believe it that it was and is. And the real focus is on, is your portfolio positioned properly to participate in this massive transition from industrial, internal combustion engines, because transport's the single biggest, at least in the US, single biggest greenhouse gas emitter is transportation, not power generation. If you look at Europe with the Green Deal and the Joint Recovery Fund and the money that's going to start to flow, focused on clean energy and on improving their carbon footprint, as I think I mentioned last time, we've had in the last 6 months a massive percentage of the global economy commit to net zero by 2050. China, South Korea, Japan, and the United States, coming back in the Paris Accord, all have committed to net zero. That means it's global. That means there's going to be a significant amount of money focused on this. And again, you can see it in the venture capital allocations to clean tech, to clean energy, to climate. The amount of focus on things like hydrogen and carbon capture, et cetera. And so to me, it's I completely agree. And as I said, the portfolio is expressed in electric vehicles, in clean energy, in other areas as well. But sticking with climate, climate's the natural follow-on for COVID speed, to shift from COVID, which is clearly global, to climate, which is clearly global, is not going to be addressed by individual country, has folks working on it and allocating capital to it all around the world, and things can scale up very, very quickly. And the opportunity, again, as I said, with the SPACs and IPOs, we should be looking at that, I mean, not to buy blindly, but to look at that as a way of the system responding. Because what the bubble is the inverse of a bubble. There's not enough instruments for folks to participate in. So when you have one electric vehicle company in the United States, Tesla, it's going to have a massive valuation because there's a lot of money that wants to participate in that theme. You have one charging station company, BLNK, same thing. There's only one. Well, in a couple of years, with a couple of SPACs and IPOs, there'll be 3, 4, and 5. And the question will be, can Blink still maintain its dominance? But right now, we have an imbalance between the instruments available and the amount of money that wants to participate. And by the way, it's kind of like crypto and Bitcoin, right? We were touched earlier before we came live on Elon Musk tweeting that Tesla has made an investment in Bitcoin, and lo and behold, it's up 15 or 20%. And I think the issue is not the tweet, but the idea that institutional adoption of Bitcoin as an asset, as a store of value, when we're doing all this aggressive fiscal and monetary policy, and we're spending all this money, I think the institutional adoption is what people should be looking for. And so it's not Elon Musk, it's Tesla, which is a publicly traded company with a board of directors, and it's BlackRock. I mean, for me in particular, as I wrote in my monthly 2 weeks ago, BlackRock saying that its global allocation fund can invest in Bitcoin futures is a game changer. It means anyone who is running global asset allocation money, who theoretically competes with BlackRock, which is the 9,000-pound gorilla, has to contemplate whether or not it should have crypto assets in its portfolio. So that is, again, an example of demand and supply. And what we're seeing is kind of the back and forth, albeit with, yes, liquidity provided by the central banks, looking for the proper home. And that is what we as global multi-asset investors and allocators should be thinking about. That's appropriate in my view.
No, I agree. Fantastic. And going on to policy, and I think you seem to agree that Democrats, they will go big and they'll go it alone. I would like to say to ask if you think there's any implications for the U.S. in a political environment. They'll simply ignore the Republicans and move on. But also in Europe, with Mario Draghi, Super Mario, back. I mean, I think it's the guy that saved Europe. Now he's going to save his own country. I mean, I think it's the best opportunity for Italy in a generation. I mean, how much does that change your investment outlook for Europe? Draghi, there was just, a Bloomberg article saying that he wants to make a priority for Italy to have a European budget. If that's the case, I mean, and if the growth prospects for the region are enhanced, it seems that the German bonds are even more toxic than U.S. Treasury. I mean, given where they're trading, right?
Yeah, minus 40 basis points.
Yeah.
Yeah. I mean, you're there. You've got your feet on the ground, and I think very astute comments. I mean, I think to talk about the U.S. political system first, I think President Biden is willing and somewhat eager to work with the Republicans. I mean, he is a man of the Senate. He had 40 years. He was chair of the Foreign Relations Committee. He was vice president. He negotiated with Republicans for decades. A large part of the question is whether Republicans have any interest in negotiating with him. And so I'm not sure how much bipartisan legislation there will be. But I think there is, in my view anyway, a real opportunity for going big and going fast, getting that first W, that first win on dealing with COVID, and then unleashing the economic rebound that is going to naturally follow without a question of a doubt. We deal with COVID, economic rebound follows 100%. And the political payoff for that is, I think, a much more robust 2022 framework, because the Republican kind of obstruction idea is that they don't allow for success. The midterm elections, the incumbent party gets hammered and they go off to another cycle. I don't think that's likely to play out in this current environment. I think there's a real opportunity with COVID and the economy to for the Democrats to do better in 2022 than they did in 2020, and likewise in 2024. And so it's going to be a calculation, but to me, the bigger issue is that there are tremendous needs which are very popular politically and publicly, and there is money available to meet some of those needs, and wins begets more wins, and on you go. As for Europe, I think you're completely correct. Mario Draghi is the man of the moment. I think he will form a government in Italy. I think that government will have, again, significant potential. There's public support for him running the country through the next electoral cycle, which I think is in 2023. So he has a good several years. The money that will be coming from the European Union is significant. I think it's between 200 and 250 billion euros coming to Italy specifically. I think Italy is the single biggest recipient of the Joint Recovery Fund money. So there's every opportunity for some success in Italy as well, which then reinforces the opportunity for integration. So again, think about it, right? Italy, like, let's get rid of the euro. 2 years ago, 3 years ago, populism, Salvini, we don't want the euro. We don't want to be told what to do. Today, 2021, Mario Draghi, the epitome of a European technocrat, asked to take over. European Union providing hundreds of billions of euros to Italy to help it recover. The story is completely different. So I'm on record again, because I write, that's the benefit of the Musings. I write consistently and have for years, from last year, saying that I believe Europe has the opportunity to win the decade of the 2020s between a 7-year budget, which is already agreed, a joint recovery fund, likewise already agreed, a Green Deal, also agreed, though they need to be ratified by the states, some of that. But those three things together and the joint issuance of debt to fund the Green Deal, and the likelihood of joint taxation following that, and the integration that those two things mean, joint debt issuance and joint taxation to pay off. Those are the things that have kind of been missing in Europe. And so to me, what's interesting is who is going to be the political leader of Europe, right? Is it because Angela Merkel is stepping down? So now there's a little bit of a void. And you see French President Macron talking about strategic autonomy, trying to be maybe that guy or that person for the continent. I'm not sure how that plays out. Could it be Mario Draghi if he's successful in Italy, becoming more of the European statesman? He's already had that role with the ECB. He probably could fill it very, very well. So it's going to be very interesting. But to me, the opportunity set in Europe is significant. You mentioned the bunds. I completely agree. Part of the reason for the bunds being where they are is that the bunds have to substitute for a European safe asset. And there are not enough of them because the Germans, they don't run historically huge deficits. So you have a very small supply of your safe asset. And in times of crisis, like the last year or so, makes perfect sense that value gets, driven to ridiculous levels like minus 50 basis points on a 10-year bond. So to me, there's an opportunity here in the next couple of years if Europe can seize it and execute. The challenge in Europe, as I see it, is execution. They have every idea of what to do. They have made some good strides, but they need to execute. You see it with the COVID response, right? We touched on it earlier. They need to execute on a much better vaccination process. But the other side of that is, look at the economic data. Much, much better than you would expect given all the lockdown stories. Even more important, look at the earnings data. Much, much better than you would expect from the lockdown stories. So, those are the things, again, as investors, don't just read the headlines, look at the data, and then look, most importantly, at the company level. The banks are doing quite well, and they traded 0.4 times tangible book value. I mean, to me, I continue to think EUFN is a great opportunity, and at some point, it's going to trade significantly higher. And I think that some point is going to be in the next 6 to 12 months.
No, and it's funny what you mentioned. You're talking about Salvini. If the trending topic at Twitter yesterday in Italy was Salvini Europeist. So he was always against the euro. If you look at what he said 5 years ago, I mean, of course, it's been changing gradually. But Lega they are backing Draghi. Everyone is backing Draghi, and it seemed that for the first time, Lega and PD, the Democratic Party, which have been antagonists, they seem to be in agreement with what Draghi is pretending to do. I think it's a done deal that he'll form a government. And on the leader, I mean, it may seem a kind of a long shot, but I think Europe, Italy, within Europe, they punch below their weight in terms of how much political capital how much political influence they have with respect to the size of the economy. So, things are moving in the right direction. But moving to a different subject, there's a lot of questions from YouTube on tech and specifically, Clubhouse. I mean, this is, we're not, tech experts, but I mean, do you think this changes, to some extent, the competitive environment in tech, in the sense that, I mean, to what we know that, higher rates in growth, they're kryptonite for tech, but is from your point of view, and is there more of a willingness from the regulators in the U.S. Not just to tolerate, but to foster more competition in the big platform companies?
Yeah, I think that's a key question, and I think the answer is yes. It's bipartisan. Again, we just talked about where we can find bipartisan agreement. There are two areas in the U.S. that have bipartisan agreement. One is kind of bashing China, and two is bashing big tech. And so I think very much, I think one should sell the fangs and buy the innovation, buy the disruption, buy the new technology companies. I think that's really where that's an easy kind of trade to make, in my view. I think it's interesting that antitrust and technology is not only a U.S. issue. It's a European issue, and it's, of course, a Chinese issue, right? Look at who's taken the biggest whack at big tech. It's the folks in Beijing, which is pretty amazing, right? But they have reduced Alibaba and Jack Ma down to size very, very aggressively. So I think it's interesting to me, like the interesting approach of both the U.S. and China focusing on their working classes, both U.S. and China focusing on reining in big tech. I mean, I think those are, and both of those two are in competition with each other. So if one is doing it, you probably should think that the other's likely to do it too, if they think it's, if they think it's at all a good idea. And I do think that the U.S. political system and how technology was utilized and almost weaponized to threaten the U.S. political system, which I think, in my view at least, is what has happened, makes it quite likely that, I don't know about breaking up the platforms, but the platforms getting any bigger other than naturally bigger is probably completely out of the question at this point. And so that by itself fosters more competition and more opportunity in the private space. And as I mentioned before, there are 500 tech unicorns, not the 50 that there were a decade ago. And as investors, we should be happy that we're getting the opportunity through the IPO and SPAC market to participate in more and more of these. And I think that's the innovation where folks should be focused. They shouldn't be focused on domination, right? The FANGs are domination stocks. They dominate their space. We should be focused on innovation and disruption, the next generation of dominant companies and tech players.
No, that's great, and I remember you've said this before. So to close, and given the statement that you just made about China and the U.S., and I'll let you close with those remarks. So markets seem to think that governments investing in their citizens, as you said, that U.S. and China invested in the working classes, they still have that whatever ideology that this is bad for markets, this is socialism, but it doesn't need to be like this, right? So when governments invest in the working classes and the average guy on Main Street, it can also be very good for markets, as it was in the 50s, 60s, 70s. So I'd like to turn back to you so you can finish with these comments.
Yeah, thank you, because it gives me the opportunity to mention one of my favorite ways to play the reopening in the U.S., which is the airline stocks and jets, JETS, which is exactly to your point about benefiting the working class and benefiting the majority of American people as opposed to the minority of American people who, for the most part, fly private anyway. Yeah. They're not really the target audience. So, and by the way, private jet travel is up and picking up nicely. So I look at that as a little bit of a leading indicator. But to me, when you think about the reopening trade, you need to think about the airlines, the hotels, some of these areas, the hospitality groups that have been left for dead. And when you look at jets, to me, it looks like it's breaking out. Technically, it looks pretty attractive. It's completely under-owned. And there's a huge waterfall, the waterfall from last spring, from where it is today, $23 or so, could get to $30 to fill that waterfall. And so I think there is, that's the area of opportunity. That's what hasn't been participated in yet in any meaningful way. And so if we are making headway on COVID, we are going to have the rescue plan, which is relief, not stimulus. And I think that is an important distinction. I should have made it earlier. And we have something potentially down the road, infrastructure-wise and climate-wise. I think the opportunity set for the U.S. Remains in that cyclical value space and in the non-U.S. markets and the commodity space, as we touched on earlier. So thank you for that opportunity.
You know, it's been great, you know, as usual. I want to thank you once again. Thank you, our audience, and you know, we look forward to February 22nd, which is when we're going to have our next, you know, our next talk. And you're going to have more snow today, or no?
Well, I was talking to Luana before. We had some yesterday. It's very cold today, which is why I'm wearing my sweater. It barely got above 25 degrees Fahrenheit in New York City today. So no snow though, but maybe we're supposed to get some during the next couple of days. So we'll keep you posted.
Okay, so thank you again, and stay safe.
Thank you, Roberto, and thanks everyone. Bye-bye.